Welcome back. In this video, we'll cover the Fractal Consolidations Pro Plus indicator. This tool is designed to map consolidation phases, visualize consolidation liquidity, and highlight how consolidations evolve within market maker models. Before we dive into the settings, let's start with the theory behind it. The 4 phases of price delivery. In ICT's framework, price delivery always rotates between 4 phases. The first phase being a consolidation, a sideways range where liquidity is generated on both sides. Then we have an expansion, and price will look to display away from the midpoint of the consolidation aggressively, running the consolidation liquidity and moving towards an imbalance or nearby swing point. Then we have the retracement, a price movement that pulls back to correct inefficiencies by retracing to, for example, 50% or more of the recent price lag, and this pullback often targets areas such as for value gaps or other PD arrays. And last but not least, we have the reversal, a significant change in market direction, typically occurring after liquidity has been swept and confirmed by its displacement, signaling the start of a new delivery phase. Understanding these phases is key. Consolidation sets the stage, expansion breaks it, retracement rebalances, and reversal shifts the narrative. The Fractal Consolidations Pro Plus indicator focuses on the first phase, the consolidation, and builds a narrative around it, allowing traders to track deliveries across any time frame. Time frame and consolidation type. In the settings, the first choice is the time frame. This determines the context used to measure consolidations. If set to 1 day, for example, the indicator will track daily consolidation. But as you can see, we have the auto option enabled, and the auto setting adapts consolidations automatically to your chart's time frame, which is useful for alignment across multiple skills. The auto setting aligns timeframes as thought by ICT in Essentials to Market Structure. So if we would remove the auto option, you could see the chart will now use daily consolidations. If we would select a 4-hour, it will refer to 4-hour consolidations. If we select 15 minutes, it will start to reference 15-minute consolidations. Up next is the consolidation type, and with this setting you can basically choose to use the wicks or the bodies for the consolidations. Using wicks captures more extremes, while bodies focus on the core range. Right now it's set to wicks, as you can see, and if we would enable it and set it to body, you can see only the bodies will be used inside the consolidation. Liquidity rate type and filters. You can also define how consolidation breaks are identified, again, by wicks or bodies. Right now it's selected to wick, so you can see that liquidity rates are counted when we have a wick that trades through the liquidity pool. If we click on body, the indicator will only count the liquidity rates when a body closes through the liquidity pool, as you can see right here. The filter consolidations option determines how multiple consolidations are displayed. When this filter is enabled, smaller adjacent consolidations merge into broader ranges, and this helps higher timeframe analysts see the overarching structure of accumulation or distribution more clearly. However, enabling the filter also causes the indicator to repaint those smaller consolidations. As you can see here, if we enable the filter, it will repaint them into a single large one as new data forms. For lower time frame monitoring or real-time executions, it can be best to keep the filter off so consolidations remain independent and unchanged. Kind of think it this way. Filter on is a broader higher time frame narrative, and filter off is a more precise lower time frame structure. Lookback settings. The lookback section controls how consolidations are detected. With the lookback type, we can change the different types, and it can, for example, be set to higher time frame ranges, such as the 20, 40, or 60 days following ICT's lookback theory. So we can change it from the 20 to 40 and 60 day lookback through this tab. You can also select a custom day lookback, for example, 3 days or 5 days, to refine the lookback window. You can use a time frame lookback right here. It determines the lookback based on the time frame of candles, such as a 1 day, or a 4-hour or a weekly, for example. And enabling the extremes will display consolidation liquidity even when none exists within the current lookback. And this is especially useful when price is trading near the outer boundaries of the lookback range and making extreme moves. This flexibility allows analysts to frame consolidations across both short-term and higher time frame structures. Consolidation style. Let's talk about the styling and plot customizations. First up is the consolidation color toggle. And this feature allows traders to change the color of the consolidation range only if the consolidation auto color is set to none. So in this case, we can see it's set to green, and it will display green consolidations and green liquidity pools. If we change it to yellow, for example, the boxes turn yellow. If we turn it to red, the boxes turn red. Then the liquidity pools. We can choose to enable swing points from the consolidations to be extended, useful for knowing where liquidity is engineered from consolidations. Then we have the equilibrium, and this toggle plots the midpoint or 50% of the consolidation, useful to visualize order blocks, fair value gaps, or other PD arrays near this level. If we set the consolidation autocolor to order flow break, when a consolidation closes above, it signals bullish order flow and is plotted in blue. When a consolidation closes below, it signals bearish order flow and it's plotted in red. In addition, autocolor can be adjusted to highlight whether consolidations act as a high resistance or low resistance, giving traders deeper insights into how price might interact with specific consolidations. And this makes it easier to visually interpret both the direction of order flow and the structural role of consolidations with the broader price narrative. Now, here's an analyst insight. When high resistance liquidity run consolidations are detected, traders can look at price to respect the rejection blocks and fall short of the consolidation break. And if price breaks a high resistance liquidity run consolidation with a clear imbalance, just like we can see right here, this could signal a deeper run into further liquidity and showcase a more meaningful break in order flow. And as you can see, after we break this high resistance run with a clear imbalance, the market runs up to all the outstanding liquidity pools on the upside. Market maker models. The real power of this indicator comes when linking consolidations to market maker models. The cycle shows how consolidations are not random chop. They are engineered pauses designed to accumulate orders and set the stage for a next phase. And a big insight for this is traders can look at overlapping consolidations when the filter consolidations is turned off to create the foundations for the original consolidation during a market maker model. So as you can see here, we have a lot of overlapping consolidations, and this is usually a sign that it could be a original consolidation. If we would enable the filter consolidations on, we can see that it now translates to one big consolidation, and the overlapping consolidations get hidden. When 2-3 consolidations overlap, it can be a sign of a new larger phase to transpire. In this case, we are looking at a market maker buy model, and you can see how we have the original consolidation. We have the smart money reversal, the first stage accumulation, the second stage accumulation, and then it rates the original consolidation. And for the second example, we can see a market maker sell model. What we can see is two overlapping consolidations, a first stage and a second stage move. Then we have the smart money reversal with a first stage and a second stage distribution. An interesting fact that we can see is how we should overlap the accumulation and distribution phases across from each other. So when you extend these out in the future, it helps you estimate where a possible distribution can occur. And the same way goes for market maker buy model. By extending the distributions, you can find the possible place for a future accumulation. That's the overview for the Fractal Consolidations Pro Plus indicator. By mapping consolidations, liquidity pools, the equilibrium, and aligning them with market maker models, it provides a framework to see how price builds and neutralizes liquidity. If you have any questions about the tool, you can visit Toodegrees HelpCenter for a detailed guide on the indicator and the full settings. And if you have any other questions, make sure to join the Discord. Thanks for watching, and I'll see you in the next breakdown.